The US dollar is essentially unchanged from the level it traded at when our September market outlook was released. In between then and now, however, the risk-on recovery trade that has been with us since mid-March has seen an abrupt test. In isolation, a near 2% appreciation in 7 days is significant, but prior to this move, the US dollar DXY index had fallen close to 10% from its March peak. This context points to the recent run higher in DXY being of little consequence. Our base expectation remains that we will see further weakness in the US dollar. From the US perspective, a trend decline in the US dollar is justified by the FOMC's open-ended asset purchases. Ultra-accommodative US monetary policy is required as far as the eye can see, with a decade of sub-2% inflation now expected to stretch to nearly 15 years, even with above-trend growth from 2021. The quality of the US recovery also remains an open question. The jobs that have been recovered to date have principally been furloughed workers brought back as the economy reopens. Based on the underutilisation and hours work data, many individuals in this situation continue to work materially below their capacity. This is a stark contrast to China, where not only has aggregate activity already regained its losses in full, but a new growth cycle is beginning with gusto. As a result, we look for the renminbi to continue to outperform, US CNY falling from 675 to 630 by December 2022. The recovery and risks are also with Asia more broadly. This assertion has an obvious basis for nations that have fared well through the crisis, such as Taiwan, South Korea, and Singapore. But even the underlying fundamentals of a nation like India, which has borne a terrible cost during this pandemic, warrants a strong expectation of recovery. This potential is why we expect US Sing to fall from 136 to 130 by end 2022, and US INR to fall from 73 to 64 rupee. Coming back to the Northern Hemisphere, there is a far greater degree of ambiguity over the outlook for US dollar pairs. The risks discussed above for the US labour market and business investment are also applicable to Europe, and while the fiscal outlook is currently more supportive of the euro area than the US, this could change after November's US elections, if a more cooperative, cohesive political climate emerges in the US in the new year. To our base expectation for Euro-US to rally from 117 currently to 125 at the end of 2021, there is then a clear downside risk. This is also the case with respect to COVID-19. While the number of new cases on the continent remains lower than in the US, as we are now beginning to see, euro area authorities are far more likely to respond with the sort of restrictions that would induce another sharp economic contraction. What can be said with greater confidence is that the UK is set to underperform both the euro area and the US. This is evident from the economic recovery since March and in the new case count. The UK economy now also has to contend with the withdrawal of government stimulus. Intriguingly, this does not necessarily mean that sterling will fall materially against the US dollar over the forecast period, or indeed the euro. The chief reason being that sterling is at an abnormally low level versus history, and there also remains a presumption that the weight of Brexit will soon lift. Against the US dollar, we look for sterling to rise from 129 at present to 140 by early 2022. Versus euro, sterling is most likely to largely mark time over the forecast period. We'll see you next week.